It's not uncommon to hear people use the terms mutual funds, index funds, and ETFs interchangeably, but the truth is that these investment types are not the same. In today's video, I'll be giving you the must-know basics of each of these investment types, and stick around to the very end because I'll be giving you 3 key questions to consider before you start investing. A mutual fund is an investment fund that pools together money from different investors and puts that money into securities like stocks, bonds, and short-term debt. So basically, a mutual fund is kind of like a variety candy bag that you could purchase at Halloween that would have like Snickers, Twix, Tootsie Rolls, and so on. But in this case, the candy would be the different types of securities. Mutual funds are actively managed, which means that there are stock pickers, so think managers or analysts, who will pick the individual securities that make up that mutual fund. The fund managers will do the research for you, select the securities that they believe will perform well, and then monitor their performance. Because the funds are being actively managed for you, there is a fee that you have to pay for that service. The annual management fee can range anywhere from 0.5% to 1.5%, but it's important to know that any fee over 1% is considered to be very high. So you definitely want to keep that in mind when you're choosing where to invest. And I know that 1% might not really seem like a lot, but over time that can really eat into your profits. The great thing about mutual funds is that they can help you diversify your investments. A primary rule of investing is to never put all of your eggs in one basket, and mutual funds will take care of that for you since they are inherently diversified in the different types of securities that make up that fund. Another great thing about mutual funds is that they can provide dividend payments. So throughout the time of investing in a mutual fund, that fund may earn income from interest on stocks or dividends on bonds, and that fund would then take that income it earned and transfer it to you in the form of a dividend payment. So this is a great way to actually earn passive income from your investments. Now moving on to index funds. An index fund is a type of mutual fund with the investment objective of matching the returns of a market index, hence the name index fund. So some examples of indexes that the fund may be trying to match are the S&P 500, the Dow Jones Industrial Average, the Russell 2000 Index, the NASDAQ, and there are many more too. For example, an index fund that is tracking the S&P 500 could go out and purchase shares from every company in that index. That way, you as an investor don't have to go out and individually purchase shares from each one of those companies, but you would reap the benefits from investing in this single index fund. An advantage of index funds over your standard mutual funds is that they are passively managed. The specific mix of securities in the index fund is automatically set up to match the benchmark index. This means that the fees associated with index funds tend to be lower than the fees associated with your standard mutual fund. For example, the Fidelity Index Fund FXAIX, which is an S&P 500 index fund, currently has an annual fee of 0.015%, which is incredibly low. So less of your money being skimmed off for fees means more money for you in the long run. Moving on to our last type of investment fund, the ETF. ETF stands for Exchange Traded Fund. ETFs are a basket of diversified securities that operate like an index fund, but a key difference here is that ETFs can be bought and sold throughout the day on a stock market exchange in the same way a regular stock can be. Because of this, ETF share prices fluctuate throughout the day, which differs from an index fund, which is traded once a day at the end when the market is closed. ETFs can own stocks across various industries, or they can be more specific to one type of industry or sector. For example, Invesco QQQ, which tracks the NASDAQ 100 index, consists primarily of technology stocks. Many ETFs are managed passively and thus tend to have low expense ratios, which is great because then you're not losing a lot of money to management fees. But it is important to note that not all ETFs are managed passively. Some are managed actively, and you will have to pay more in fees for those ETFs that are actively managed. One additional key difference between mutual funds and ETFs that I want to call out is that ETFs are tax advantaged. So every year, mutual funds are required to pay out to investors the capital gains that they have made on their investment in that fund, even if the investor did not sell their shares. And you are required to pay taxes on those capital gains. ETFs, on the other hand, do not have an annual capital gain distribution requirement, and you are only required to pay taxes on the capital gains when you sell your shares. So now, if you're wondering which investment fund to pick, here are 3 questions to consider before you start investing. Number 1, what fees and expenses are associated with this fund? Remember that fees above 1% are considered to be high. Number 2, what are the pros and cons of this fund? So consider if you would like the option to trade the fund during the day like you can with an ETF, or if that does not matter to you. And also consider the tax implications of your choices and whether or not that makes an overall difference to you. Number 3, does the fund's investment strategy fit in with your investment goals? Make sure that you are comfortable with the choices of securities that make up the fund that you are considering investing in. You want to know that the choices you're making are consistent with your overall long-term investment goals. So now you know the basics of mutual funds, index funds, and ETFs. And there really is no right or wrong answer into which type of investment fund you should pick. It really depends on your personal situation and your preferences. And if you want more beginner investment content, subscribe to my channel because next week I'll be posting a video walking you through step by step how to invest in index funds. Comment down below if you have specific topics that you'd like to hear me cover on this channel. For now, go ahead and click the video on the screen to hear about 12 money habits that you can start implementing today to completely transform your finances.